Chapter 5, Employee Fraud, the Misappropriation of Assets. In this chapter, we're going to look at how employees might steal from the company, whether that's taking cash, inventory, property and equipment, anything like that. So let's look at this in more depth. Now, first of all, employee fraudsters. One person, found the following characteristics of occupational fraudsters. Occupational means employee fraudsters. You can look, through these yourself. Egotistical, risk taker. Now, hard worker, you'd look and say, well, I'm a hard worker. Does that make me a fraudster? Well, no, it doesn't. It means that over the years they have found that people who've committed fraud are hard workers. They're hard workers in the company, and then apparently they're hard workers in committing the fraud and covering up the fraud. The others might sound more reasonable: greedy, disgruntled, desire for personal gain, so forth, under strain. So you can see that these have been found to be characteristics of fraudsters in the past, and I'm sure going into the future. One thing you should always keep in mind, whether you're actually on a forensic investigation or you're an employee in a corporation or whatever, that certain items may indicate fraud. So in the first one here, if you find transactions that are not recorded in a complete or timely manner, or are improperly recorded as to amount, accounting period, classification, or entity policy, you need to find out why. It might lead you to fraud. It doesn't say that this does prove fraud, but it could lead you to finding fraud if it exists. The others are very, very important. Unsupported balances, last-minute adjustments. The last one, evidence of employees' access to systems and records inconsistent with that necessary to perform their authorized duties. So you might wonder why an accounts payable clerk has access or authority over the inventory or the inventory accounts. Maybe that should not be that way. So be careful about, if you have employees with specific duties, make sure they have only access to the accounting records that they're supposed to have access to and no others. Types of misappropriations. We're talking about theft here. So the first one, embezzlement. You've heard of that quite a bit over the years. People are stealing from the company. Usually cash. It could be other property. The second one, some cash and check schemes. Larceny of cash is stealing cash after it's already into the business. Skimming is taking cash for yourself personally before it's recorded in the business. Check tampering. You have checks prepared and somehow you can later on change the payee. I've heard of people using erasable ink to do this. Kiting. You're making deposits from one bank account to the other in rapid succession to make it look like you have large balances in all these accounts. And really, it might just be one set of funds that are showing up in all the accounts sort of at the same time, because they're deposited into one account and then it might take several days before it's withdrawn from a separate account. Credit card fraud has happened quite a bit in the past. So be careful with employees who have company credit cards. I've read about situations and seen situations where people have taken those credit cards and purchased personal assets with those. In the accounts receivable area, there can be lapping. That's where, let's say you take a payment from a customer. So you open the mail, you take the check or whatever, and somehow you can get the check in your name, but you take the money or the cash, the check, and you take it for yourself. You don't apply it to that customer's accounts receivable. What you'll do then is when a later payment comes in, you will apply it to that first person, the one you stole from, to their account, so it gets that covered. But then you have the second account that's not covered yet, and you have to use a third payment to do that. And all the while, you're probably taking parts of these payments from each of these. Fictitious receivables, another one. Maybe you need a debit in the accounting records to cover up your theft. So you might just create an account receivable. Debit accounts receivable, credit the cash that you stole, all the accounts balance, but you have a fictitious receivable. Inventory fraud has happened a lot over the years. You have to worry about employees stealing inventory. You have to worry about them inflating inventory value to cover up their theft. Accounts payable fraud, double billing. You might double bill your customers, and you might take some of the money yourself. Shell companies, you might, as an employee, go set up a fake shell company and then have accounting records, accounting entries with that company that allows you to steal from your own employer. And you have your employer like pay your shell company, and that company owned by you gets the cash, and it's recorded properly. Well, it's recorded, I should say, in your company's accounting records. Again, be very difficult to find. Fictitious disbursements, sham payments. These are made when they should not be made. Price manipulations. Maybe you're in contact with a supplier, and you agree with them to let them upcharge you. Make the invoice higher than it should be, and then they split the money with you. It's happened a lot. Money laundering, we have a complete chapter on that later on. That's where you're trying to make money that was taken illegally and make it look legal. Bid rigging, we'll talk about that later on. Fighting fraud. What can a company do to help prevent employee fraud? First of all, have a good business ethics policy. Set that tone at the top. You want to make sure that the leaders in the business, upper management, follow a good ethics policy, and the employees will see that, and hopefully that will prevent them from committing fraud. You want to reflect the company's position on fraud in the rules of conduct, even employee manuals, things like that. And the others you can read yourself. The next to last one, have a forensic accountant review and help to audit the company's security measures. How can we prevent or detect employee fraud? Well, have a fraud hotline. You're going to find that very little fraud, very few cases of fraud are found by external auditors. Most fraud is from like a tip or something. So have a fraud hotline so someone can call in and not have to give their name and report something going on in the business. Institute a mandatory vacation policy. Now this might sound sort of strange, but if you are in the company and you're stealing, you're committing fraud, you're having to cover your tracks all the time, you might not want to take a vacation. You're stealing so much money that you're fine with that. You don't want a vacation. You need to force your employees to take a vacation, have someone fill in their position. So have them gone for at least a week and have someone else come in and take care of their journal entries or whatever they're doing to see if fraud is found. Rotate assignments around, have written and signed ethics policies, and then you can look at the last couple yourself. Now, other ways to prevent and detect fraud: really understand the business unit. Understand what functions your employees actually perform. If you're the business owner, that is. If you are the fraud investigator, you need to assess what the employees actually do. Do not allow employees or executives to get away with anything. Any kind of incorrect journal entry, any kind of discrepancy, it should be very clear that is not allowed. Errors, yes, they happen. Find out what happened and then see how you can make it where it will not happen again. But don't let exceptions keep going time after time after time. And small businesses that really have quite a bit of employee embezzlement themselves, the owner should open the monthly bank statements. Bank statements shall always be reconciled. If you have enough employees, you really don't want the employee who receives the cash makes the deposits, make journal entries in the accounts, be the one that also reconciles the bank statements. Okay, if one employee does all that and reconciles the bank statements, they have a good way to hide things. So you really do not want that to happen. Now, supervisors, in departments or areas or whatever, should think, how could a criminal commit fraud in my department? So as we think about what could happen, how could I prevent it? What controls can I place in my department to prevent potential fraud? Don't always assume employees behave honestly. Yes, most do, but there are the exceptions, and those are the ones that will end up stealing a lot from you. Check the employees' references and their resumes. Think outside the box. What might happen? What could happen? Sort of ties back up to number 1 there. Bond your employees is sort of like an insurance policy on your employees. They're bonded, so if they end up stealing, then you can collect on that bond to replace them if they have stolen. More steps? Well, things like count the cash twice in one day. Surprise cash account. Count cash irregular intervals. Perform unannounced inventory counts. Have a fraud risk assessment done regularly. Be aware of related parties. Are your employees doing business, through your company's name with businesses owned by relatives? Things could happen. You really don't want check signing machines and signature stamps. You need to have someone at the appropriate position who will sign the checks. And then be careful about allowing employees to make side agreements. They cannot do that. Make sure the person at the appropriate level, supervisors, managements, those are the ones that make side agreements. Once fraud is discovered, the first thing you do, call legal counsel. If you are a large corporation, you might have your own legal counsel. If you're a small business, get your attorney, in there. Tell them what's going on. Second thing, get the insurance carrier involved as early as possible. If fraud is going on and insurance would cover it, the insurance policies will state you have a certain amount of time to let us know about potential fraud. It could be a matter of days, it could be a matter of weeks, but if you go too far and not tell the insurance carrier, you might not get insurance proceeds paid to you when otherwise you could have. And also the insurance carrier wants to I don't want to say oversee, they want to see what's going on, and they might help with the investigation. Third, very important, take immediate steps to safeguard existing assets from further damage. You don't want more theft to continue. You don't want more assets like inventory or equipment to disappear. Do what needs to be done to make sure your assets are protected. Quietly and confidentially gather evidence. You want to delay as much as possible the person you suspect knowing an investigation is going on. They might start covering up evidence, destroying evidence. Now, 3 and 4 taken together, if you really believe someone is stealing from you, like almost on a daily basis, you would have to remove them from that position, and then they would know that what's going on. So you have to balance 3 and 4 there together. And management information on a need-to-know basis sort of ties back to number 4. Watch your communications. Number 7, consider setting aside time immediately to scope out an action plan. To me, this should be higher up. This needs to be done like immediately. And then number 8, consider those who might assist in the crisis and take steps to eliminate any conflict of interest issues. And number 9 here, once you're ready to prove fraud, and you'll have to prove it in court if you're going to take this to court, but consider prosecution. If the others see that one of their colleagues was taken to court, found guilty of fraud, that will hopefully make them not consider committing fraud and stealing from you themselves. These are just some more techniques. You can look at this yourself. Timeline analysis, tracing schedule, genogram. That's where you sort of pictorially show relationships between people, between companies, and so forth. Entity charts, net worth method. We cover that in Chapter 6. There's a Form 1099 technique that if you find someone has embezzled from you, well, embezzlement income is taxable. So your corporation would have the right to issue them a 1099 that would catch their attention. And you maybe could threaten them with that. You say, well, you either pay me the money back or I'll issue a 1099 and then you have to report that on your taxes because it's going to be reported to the IRS. And so if your corporation actually does this, files a Form 1099 reporting this embezzlement income, then you get a deduction for it. It was stolen from you. You lost the cash, and so you get a deduction. And the person who committed this has to report this on their tax return. And finally, the last slide, a conflict of interest policy. Yes, you need to have this set up. Let your employees know about it. There should be no conflict of interest. So again, as I mentioned a minute ago, an employee, like let's say a purchasing agent in your business, should not really be dealing with another company owned by a relative. That's a conflict of interest. That's too close there. CPA firms, they will make sure that their employees don't own stock in the company they're going to go audit. That's a conflict of interest. I own that company that I'm getting ready to go audit. That's a blatant conflict of interest. And the Sarbanes-Oxley Act, that last point, has conflict of interest requirements. So you can go back and read that. All right, that's it for Chapter 5. So good luck with your studies.